Lee just went on CNBC to explain his 2030 S&P 500 price target of, get this, 15,000. Today, it's at 5,450. So that's big returns. Tom Lee's essentially saying you are going to get rich over the next couple of years. Tom Lee also explains that there are risks in this market, that potentially AI does turn out to be a bubble, or AI becomes sentient and destroys nations. Yeah, like, no kidding. That's what Tom Lee just said. AI could go rogue. This is something Elon Musk has warned about many times in the past, but not something we have heard from any Wall Street guys just yet, besides Tom Lee. Despite all of that, AI potentially going rogue and the likes, AI being essentially a bubble, Tom Lee is very bullish. And I've been quite conservative recently, quite defensive, and I'm starting to rethink a lot of that. So let's run the clip, and then we'll be back to break down everything you need to know specifically in regards to Tom Lee's latest, just jaw-dropping prediction.
Let's ask the man himself, because he's sitting right next to me. Tom Lee, good to see you.
Great to see you, Brian.
You have not been drinking?
No.
Okay.
Not recently.
Not recently. 15,000. I'm just going to sit here and listen.
Okay. Well, there's a couple of reasons behind this. One is this would be the third time that stocks entered a cycle where annual returns compound at high teens. You know, you had the roaring 20s, and then you had the 50s through the late 60s. Mm-hmm. And this is a third cycle. They all coincided with a surge in the number of people aged 30 to 50. So in other words, the number of prime age adults. And this time it's powered by millennials and Gen Z.
Just so everyone's crystal clear on what Tom Lee just said there, Tom Lee said that he expects the S&P 500 will compound over the next couple of years at double-digit paces. So in 2023, as great of a year that was, at certain times better for certain areas than others, it was still a pretty narrow market, let's be honest. The S&P was up 24%. So far, the S&P 500 is barely up double digits for 2024, up about 15.5%. So Tom Lee is saying you could get 20% this year, 20% next year, 20% in 2027, 20% in 2028, another 20%, another 20%, and boom, you're at 15,000 on the SPY. In other words, he's saying you're about to make a lot of money in a short amount of time. Let's just hope if the markets do go to 15,000 on the SPY, it's more than just 5 stocks, which theoretically it would have to be, right?
So is this the law? Okay, so math. I wasn't not great at math, but I'd like to think I know a little bit. Big numbers get bigger faster. That compounding.
That's right.
And you think there's that, but there's also this massive wave of people about to enter their peak earnings years.
Yeah, so it's a...
Demographics.
Exactly. It's a demand story, meaning when you get to your prime years, 30 to 50, Urban Institute shows you start to borrow more money, you're making big life decisions. This is what powers the economy. On top of that, we have really a big opportunity for U.S. technology companies because of AI, which is supplying the global digital labor because there's a global labor shortage. So these two forces are combining to, I think, power almost a decade of extraordinarily good stock returns.
Do you have a view? Is this because we're the United States? I mean, and do you expect that a lot of money from around the world, because China's got massive demographic issues, Germany shot itself in the foot with all of its energy problems, will we be helped by a lot of money coming into America, or does that have nothing to do with it?
It's actually both. I think that there's going to be a lot of dollars spent on U.S. technology product because the world is short 80 million workers by the end of this decade. That's roughly $3 trillion of labor shortage, of labor salary that's turning into silicon. So that means U.S. suppliers of silicon and AI are going to have a $3 trillion revenue run rate. On top of that, if U.S. companies are growing earnings at this speed, the PE multiple of the U.S. should go up, and that's exactly your point. There's going to be capital flows into the U.S. And where else in the world do you find the best and most important technology companies? They're all basically in America.
They're all here. I mean,
Yeah.
it's amazing to me that NVIDIA alone, folks, NVIDIA by itself is worth 50% more than the entire German DAX index of stocks combined.
Yes.
The 30 biggest companies in Germany, or 33, however many are in the DAX, combined are half the size of NVIDIA.
Yeah.
Because we have liquid capital markets. We have American ingenuity. We have an amazing workforce. 25% of company founders, by the way, are not born here because we allow a lot of immigration. It's a bold call. What's the risk? When you look at it, you've always got to analyze, say, well, where could I be wrong, right?
Yep. Well, I think there's a risk that we could have
Global recession?
A global recession. AI, of course, could become an adversarial development and, upend state nations and cause chaos. But we could also have a risk that it's a bubble and it peaks a lot sooner.
Yeah, and you wonder, by the way, this is a little bit off topic, but I saw some huge bets being placed, and there was a note today, and you forgive me, a senior moment, I can't remember exactly who put it out there, but that there was a huge bet placed in the interest rate market that the 10-year would be at 2.25% by like next March. That there'd be this massive decline in yields, either because of the Fed, recession, whatever. You have a take on that?
I mean, that obviously is a very cheap bet because I'm sure the skew is for higher rates, not lower.
So it's like a high risk but high reward bet.
Yeah.
Not high risk because you're not betting a lot of money, but the odds are you're going to lose your money.
Yeah, it's like a black swan kind of trade. I think it's possible because, inflation internals are collapsing. I think the headline core CPI, and we'll get Friday's PCE, they're being propped up by housing and auto insurance, which are two components, but the rest of the CPI index, 55% of the CPI basket is below pre-pandemic inflation rates now. It's the highest in 4 years. The 20-year average is 50%. So inflation is tanking.
Except for the home and auto insurance. That's a big deal.
Yeah,
by the way,
money.
I heard there's going to be some big rate increases coming to New Jersey, folks, by the way.
I mean, just overall, that makes a lot of sense, right? You don't want to bet against America, even if you're super bearish. It doesn't matter. Who wins the election doesn't matter. How long inflation takes to go down doesn't matter, as long as we don't go into hyperinflation, which this Fed seems damn well sure that doesn't happen. Keeping rates higher than they need to instead of loosening too early. After all, maybe that's a good thing because the Bank of Canada just cut rates 2 weeks ago and they just had a surprise super bad inflation number today. Like really, really bad, almost 1% month over month. So maybe the Fed's doing the right thing after all, trying to thread the needle through a very, very small hole. As I have said many times before, you can be bearish in the short term. You can think markets need to go through a correction, and there can be corrections. On average, during an election year, you get a drawdown of over 13%. We have seen a 5% drawdown, and that was back in the spring. Do we go through a correction between now and the end of this year? Probably. But what will ultimately happen is we will be set up for years and years of a bull market. In fact, I actually talked about this about a week ago. In fact, 7 days ago, exactly a week ago, I made this video, multi-year bull market is coming. Now, the premise of that video is a great one, and I think you guys should go watch it if you have not already. But let me go ahead and give you the long story short. Once we do go through some kind of large correction, maybe it's a correction in AI because expectations are too high, maybe it's a correction in big tech, or maybe we don't get a correction, maybe big tech just doesn't do anything for a couple of years. Just like small cap stocks haven't done anything in 2.5 years, maybe that happens with big tech and the markets actually get fueled from the bottom up, meaning just a broadening out of our markets. You don't necessarily need to see an epic crash or correction you could just see nothing happen in big tech for a while. The problem is, I think big tech has pulled forward many years of earnings growth, and it's already baked into those stocks. Whether or not we see Nvidia miss on earnings or something bad happen with Apple or a recession, that's what will really give you a catastrophe-like event, 20, 30, 40, 50% pull down in markets. But again, that doesn't necessarily have to happen. But just adding to what Tom Lee said about the next couple of years, call it the next 5 or 6 years that are going to be very strong in markets, there is an effect of inflation. When inflation rises and then comes down, you tend to get wages that stay the same and continue to rise. You tend to get prices for things that don't come down. Not too often do you actually see deflation. So what happens if you're buying a stock at today's prices, just call it the S&P 500 to keep this simple. Expectations are around $260 of EPS for this year. Well, with all of this inflation, with all of these wages that have risen, especially when inflation does come back down again and consumers feel confident to start spending money, now they have 20, 30% wage increases. And what happens? People go out and spend money again. So maybe it's Dollar General you bought at a $30 billion market cap. That's now bringing in 2-3 times as much money as they did in 2020 because of high inflation, because of wage increases. You bought your investment at a fixed price, at a $30 billion market cap. What happens? Dollar General starts to do better because of all of the wage increases, people spending money, and now it's a $100 billion company. In all reality, it's because of inflation, because people got more money, people got higher wages, and you're buying it at a fixed price. Again, in that video, I did reference housing as well. I think housing is probably the best example of this, but imagine a house in California. I don't live in California, so choose the area, and I think this applies. You bought a house in the 70s for $50,000. Today, it's worth $2 million, right? If you bought in a good area. Well, what's happened since then? The home is still the same as long as you kept up with it. It should be just fine. Same applies for your investment, assuming it's all fine. Wages have went up. That's it. That's what happened. Wages went up, and yes, you did have Silicon Valley, and a lot of people moved to California. That obviously plays a role in it, but it's the same premise. You bought your home at a fixed price, and now everyone makes more. I mean, people probably make today in California in a week what people made in a year in 1970. Not going to do the math here. Maybe it's a couple weeks, but you understand the point, hopefully, that I'm trying to make. So add that on to what Tom Lee just said, and I'm very bullish on America's future as well. And really, if you are a tech investor, America is the place to be. And I'm an American. If you're somewhere else, then maybe you don't understand this, but never bet against America. Financially, militarily, don't bet against the people. Just don't do it. It's always going to end in disaster. So let me give you a little bit of the game plan going forward. Like I just said a couple of minutes ago, I still think there's a chance of a large correction, if not outright crash. That happens one of two ways. If the Fed becomes delusional, think they need to raise rates or not cut rates, and the economy continues to weaken, and maybe we do go into a recession, that's a problem. Okay, really a big crash comes down to a recession. But before you go into a recession, markets will price that in. So as the odds start to rise of a recession, you get downside in our markets because earnings expectations start to fall. And it really comes down to inflation. Here's the problem though. If the economy weakens over the next 1, 2, 3 months, the Fed's probably not going to feel confident enough to cut rates. And if that happens, you're probably going to get even more weakening following that. It's probably not going to be just the next couple of months weakening. Things are great again. It's probably going to continue to weaken until the Fed is at a point where they're forced to cut rates. If the economy, and in that scenario, you get an outright crash. If indeed the economy does hold up for the next couple of months, inflation does fall like a rock, like Mark Newton said over at Fundstrat. He is the head of technical strategy at Fundstrat. And what Tom Lee said in this clip, if inflation just falls over the next couple of months, the Fed can gain confidence to start cutting rates, and we don't see another resurgence in inflation, then maybe, just maybe, the Fed will be able to cut rates in time to avoid a hard landing. That's why the data is going to be so critical here. And we do get data coming out in just the next couple of hours with durable goods orders. You are expecting a positive 0.1% number month over month. If that comes in negative, not a big deal. Last month was positive 0.7%. So if you've seen like a negative 1% number, that would be really bad. But negative 0.1, 0.2, 0.3, not a big deal, but that will be important because the consumer is over 70% of this economy. The consumer spending money, that is. And then you have your PCE report on Friday, which is very, very important. We're expecting a really good number of 0.1% month over month. If that comes in at 0% or negative, woohoo! Oh boy, it's going to be off to the races, not just for your AI or big tech, but a broad market rally. And then preceding this week's data, well, I should say on Friday, you also have personal spending data that's a little bit different than just durable goods. That is more just durable goods. Personal spending incorporates services, incorporates other parts of the economy as well. That number will be very important to judge the state of the consumer. And we do have initial jobless claims coming out tomorrow morning. And as long as that's not super bad, a super high number, we're probably going to be just fine. Over the next couple of weeks, we will get CPI, we will get retail sales, the start of earnings. The next CPI report comes out around July 11th or so, as it typically does, the 11th or 12th of every month. That will be important. That could actually set us up for the first Fed rate cut coming July 31st. And if the markets can start to price that in now or here over the next week, 2-3 weeks, that's where you could get a browning out of the markets in the near term. Currently, the markets are pricing in about a 10.3% chance of your first cut coming July 31st. These odds could start to rise good, and that should lead to a broadening again of our markets. And again, historically, the S&P rallies over 2% in just the first 2 weeks of July alone. So historically, seasonally, the next couple of weeks should be very good for markets. And you do have almost a record divergence between the Russell 2000 and the S&P's performance. The Russell's up like 1% this year. The S&P is up 15.5%. That's a spread of about 14.7%. That's the actual number. The second worst year was 1998 and, 1987, I believe. And it was about 14.8%. So you're 1 point off of the second worst underperformance of the Russell in the last like 50 years. Now, 1998 was a 30% difference, and well, I don't expect that will happen, but it's possible. I mean, let's hope it doesn't, because that means small caps get a lot worse, and that means S&P rises a lot more, and there is no broadening out of our markets. But the most likely situation here is you do get a broadening out of our markets, or you see a catch down. You either see a catch up or a catch down. Catch up, not like your condiment, but catch up is the rest of the markets catch up to big tech. A catch down would be the top 5-10 stocks catch down and start to fall and match the rest of the markets. And honestly, it's going to be up to the data to determine what happens next. I think earnings are going to come in good. Small caps are actually going to be posting better year-over-year earnings growth than large cap names. The perceived level of safety with large caps may keep more money in those areas. So as long as the economy holds up and we get some good data and inflation continues to fall, earnings growth is reaccelerating again for the first time in a long time. And you're actually going to see better earnings growth again for the Russell than you are for the S&P, which just doesn't happen all too often. And that could really help the broadening out effort. But with all of this said, let me know what you think about this down below in the comments section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. Most importantly, have a great rest of your day, and I will see you in the next one.